Okay, welcome everyone. We'll start our fourth lesson on Unit 4, Financial Management Accounting Technique for Managers, ATHE Level 4 Extended Diploma. And today we are covering is LO3, Learning Outcome 3. Few things left during our last lesson, so I'm just a bit recapping to assignment brief with you as well. So if you have any question, feel free, just ask me and drop me email as well. So for I think today lessons, let's will recap what we learned. So in previous lessons, what we learned, LO1, we discussed about 3 assessment criteria, understand financial and management systems. So where discuss about accounting system, management accounting systems, and complementary accounting systems, imply the function and management tech recording the information, and evaluate full of managed financial statement. So we discussed use of financial statement, how we can record transaction in the book of accounts. So we discussed book of prime entries, book of so it went through inductive contents, management and financial accounts, user output, monthly, quarterly report, and use of ratio. Legal requirement, financial accounting, legal requirements, management accounting internal, which we discussed, the double entry good approach, which is based on the debit and credit. We discussed books, purchase, all these have both debit and credit side. We discussed 4 financial statements, prepare these companies, private limited, and we discussed difference between private and public limited as well during our lesson 1. And I also about the management accounting system, cost accounting system, inventory system, we have average, and we discuss cash flow forecast, which I discussed in the LO3 as well. Investment method I discussed with you. That's a part of income under the management LO3 as well. Stakeholders and interest you question anybody, please feel free. LO2, we have 3 assessment criteria: the working capital, the running capital, the facility shows our working capital. Explain how we can manage, and we discuss ratio. So today I also copied the lessons as well. And the second lesson we discussed bank cash balances, trade receivable, trade payable, inventories, working capital, adjusted employees. We describe of ratio, profitability, user also known as a ratio. So we're discussing our lesson to address in the LO2 and the LO3 last lesson. You budget, types of budget, variance, the difference between budgeted and actual, and we can some, but during last lesson we not cover, managed to cover everything very well. So that's what I asked in this lesson again. So last lesson LO3, again LO3 we have 3 assessment criteria, and those into and those will learn under the financial plan, where we are, where we want to, what we want. Cash forecast, we discuss about we need to manage the cash, because always when you forecast your cash or make your cash budget, we always look for your sale forecast, because sale forecast, your credit control policy in our organization is very important to control. Budgetary control process we discuss, which I'll go through how we can, what is meant by zero-based budget, which is start from the zero. Incremental budget, we discuss advantage, disadvantage. If you don't have a budget, you like in a C, you don't have a nav. So budget is provide. The nav is a set navigation. Budget motivate workers. Budget help to achieve the organization objective. Budget help to identify the variance. If we variance is a difference between budgeted and actual variance. We discuss different types of variance, and we discuss about the causes of the variance as well. And explaining variance, we discuss financial and role, and we discuss how we can reconcile them. So today lesson, I'll do the classification of cost. We'll discuss unit cost. We're dealing with the overhead, break even, and marginal costing. I'll again discuss with investment appraisal. Last lesson we also learned about investment appraisal as well. One of your tasks, in your assignment, you're supposed to go through the investment appraisal as well. Anybody, any question? Feel free and ask me, please. Okay, we'll start now. Okay, so first we'll go through descriptive intents. What do you budget? Budget is a financial plan, guys. Budget is a financial plan where we are, where we want, what we want to achieve. Budget help us to forecast. Budget help us to achieve the financial control. Break even is a point where no profit, no loss. And the costing method: marginal costing, absorption costing, standard costing, activity-based ABC cost, and product cost are these costing methods which we use to calculate the cost. Okay. Principle: marginal cost is the cost of 1 unit of product and the service that would be avoided if the unit were not produced or provided. Where it's called variable cost. If we not produce it, we don't need to pay any cost for the deal variable than with the level of output. So contribution is the difference between budgeted and actual cost. So difference between budgeted and actual cost is known as a contribution. So budgeted and okay, contribution equal sales revenue minus variable cost is equal to, it is the short contribution towards covering the fixed cost. Overhead is making the profit. So marginal costing, only the variable costs are charged at, say, cost of the sale. Closing inventory are the marginal cost. Fixed costs or the overhead are treated for the period cost, and the period costs are the chart to the full statement of profit and loss. If the sales increase by one item, the profit will increase by the contribution of one item. The contribution per unit is constant and the sales. So that's what is called the costing, and marginal costing is known as the level cost. So the difference between marginal costing and the difference in the reported profit is the difference between the fixed production overhead, including the opening and the closing valuation using the absorption costing. Absorption costing also known as a full cost. So marginal costing, closing inventory valued at the margin cost product, which is the variable, and the is the closing inventory valued at the full cost is mean both fixed and variable. So when we for head include the closing inventory, then the opening, and such cost of the goods sold for period decrease. Decrease in the period of absorption costing report lower profit, and a lower fixed overhead include in the closing inventory, so the cost of the goods sold increase and the profit will be lower. Okay, guys, anybody any questions? So that we can discuss the difference between and the reconciliation as well. So argument, fixed costs are incurred in order to make the output. So it is only fair to charge the full output with the shares of these costs. Closing inventory will be valued in accordance with the accounting standard. Appraising product is term of the contribution, give no indication whether the fixed costs are being covered or not. So anybody any question up to now? Okay, so marginal cost and absorption costing argument. Absorption costing information is irrelevant when making short-term decisions. Short-term decision mean the less than 1 year. That's come under the marginal costing where we calculate the break even. It is simple to operate. There is no arbitrary fixed cost apportionment. The fixed cost in the period will be the same regardless of the level of output. I use 100. If we have a capacity up to 1,000, your fixed cost will stay the fixed. Like in a house, you're living one person, or you living 4 people, your fixed cost is stays in the full cost to the period. It is listing the value of the closing inventory item at direct attribute to the cost of product produce an extra unit. Under an hour absorption is avoided. Absorption costs give the manager the wrong signal, and the goods are produced not to meet the demand but to absorb allocated overhead. Absorption costing profit may therefore increase merely by producing excess product, and production in the excess, the demand in the fact increase overhead, the warehouse and the organization later will bear it. Okay, so how we can allocate the cost. So cost by function, we can allocate the cost by function. These in the organization, different department is known as a functional area. Production department, selling department, admin department, and finance department. We can allocate their cost according to the function, how much activity they do in the each department. Okay, direct cost, the cost we can identify within a product, which is consist of direct material and direct labor, and indirect cost is it can be material, labor, and other expense, those not directly involved. That's also known as indirect cost. Then we can look around the direct and indirect cost. Direct cost can be coded appropriate job and the client and the receipt. Indirect costs initially allocated appropriate cost center. Allocation is a process where the cost items are charged to the cost center. Apportionment is a process splitting the cost across 2 or more appropriate basis, such as per square meter area occupied. So that we can use it to allocate the cost. Okay, then when we look, the cost can be in terms of material, labor, and expense. That's known as the main cost element, cost by element. So element by cost, so we can look around material, labor, and expense. Material included all the physical items and make the product. Labor include the payment to the labor, include the basic and overtime, which we will pay, including NI. Expense may be specified to the cost center. The cost center depends upon like a 70% services canteen offering to this department, 30% other, so we can allocate the cost accordingly, the proportion method which normally we use. Okay, anybody any question? Next we look in the cost center, different cost center, we can allocate cost center. center is the calculation for income before they analyze further well as expected. The cost profit center manager is responsible both income and cost. Investment is the calculating place for income, cost, and the capital. Capital is come under the investment divisions and subsidiary companies. Okay, budget. So last lesson we discussed about budget as well, and further we can discuss about and differentiate the fixed budget which stay the same, which won't change with the level of output. Estimated volume production and estimated volume sale, no variance of the budget and the made over and even actual budgeted activity levels differ and not adjusted in their they will reflect the actuals. They generally use the planning and define the board objective. The fixed budget are the start point and ongoing budgeting process and provide a plan target. Flexible budget are the budget which is by recognizing different cost behaviors pattern and chart the activity level. At the planning stage, the flexible can be drawn up and how affect the actual volume of output and the different budgeted volumes. At the end of the year, actual result can be compared with the flex budget and with the result should be compared with the actual output. So like your budget for 100 but not at 200, so you need to make sure our budget should be different. So cost which stay the same, variable cost, the cost which change with the level of output, and semi-variable, the cost which is consist of both fixed and variable cost. Rent is a fixed cost, it won't change with the level of output. Variable cost, the cost which change with the level of output. And semi-variable like a line rental is a fixed and the call charge is a variable, so that's called semi-variable cost, which we use high and low. If we know the total cost, high and low method of differentiation we can use. The level we're not doing it, we can to differentiate the cost. Okay, so the difference between budgeted and actual is called variance. Variance can be, and then the variance help to identify the performance, the comparison, income, cost, and the profit, and thus we can look around the price, quantity, and the period, different variances, and the managers can be responsible and they can take the corrective action. The company is making the right choices or not. Okay. Variance is the difference between budgeted and actual. Performance, if the budget is less than the budgeted as expense, so is variance is a favorable, and if the budgeted if the actual expense are more than the budgeted, the variance is adverse and we need to identify. Maybe the price can be changed between 2 to 4%, 5%. If it's, we can draw the benchmark and we say is the significant variance or not. So variance reporting is the reporting difference between the budgeted and actual performance. Budgeted holders are managers responsible for the individual budget, and significant reporting is the reporting only significant variance which is expected at the certain amount of the percentage over the period. Anybody any question? Okay, so significant variance should be reported to different level of, if we have a benchmark that variance won't be more than 5, our variance is coming 10%, of course 10% is there, so we need to be report the managers, and the managers can take the corrective action like the workers are late, we paying more money to them, the material we are buying that's not a good quality, that the usage of increase, yeah, that's we have agency staff we are using, they not really caring about the material and they use it, that material can be adverse. The labors as well, they actually using more hour than the budget, more rate than the because due to the supply and other expense administrative we can look around as well. Okay. Then we discuss about contribution last lesson as well. Selling price minus variable cost, that's called sale volume times by the contribution minus fixed cost. We can calculate the profit. So what is the formula of we need to calculate the break even in units? Total fixed cost divided by the contribution per unit. Contribution per unit is selling variable cost. If you so we can find. So if you want to be break even, required to be contribution required to be break even, we want contribution required to be break even, what contribution we required, and the contribution per unit. So we can find how much sales will be sell to find will be break even, where no profit, no loss. So next we look to the required contribution. We want like a required contribution is £2 per unit we want, and contribution ratio will divide, we can much call it will, and fixed are divided by a contribution ratios, we can find required contribution divided by the sale. These are the formulas which we can use to calculate different things in under the break even in. So if sometime we calculate the profit, fixed cost did profit divided by contribution, like in this question we have fixed cost is plus target profit is 5400, fixed cost is 54, budgeted sale is 3000 unit and variable cost. So we can difference between them is our break even in units is 1800 units in this case, and we can calculate the contribution per unit. Then the break even point revenue budgeted in units, because if you know budgeted in units, so if we'll sell the worth of the 24,000 units, will be break even. So at this sale volume, so but fixed cost plus target profit divided by contribution per unit, which is 3. So we need to sell now 2900 units to be break even instead of 1800 units. So margin of safety is the difference between fixed sales my break even sales. So our budgeted sales were given is the 3000 and the break even sales came 1800. The difference will be our 1200 units. 1200 units will be our margin of safety. So if you want margin of safety as a percentage, 100 divided 3000 budgeted sale time by 100, so 40%. So this by break even chart, even is a point where no profit, no loss, where marginal cost equal to marginal revenue. So you will see there total cost equal to total revenue, or marginal cost equal to marginal revenue. We can look around the budgeted variable cost and fixed cost. So margin of safety is the difference between the budgeted and actual. The break-even sales minus actuals. Budgeted sale minus break even, the difference will be our margin of safety. And you will see there that's the break-even point where no profit, no loss. As we sell more, the difference, the cost becoming lower, and the budgeted, the difference will be our profit. So sale volume or the revenue and the break even point where no sale, no different, the cost will stay the lower, the profit will go higher, the difference will be our profit. Next, we limiting factor, we have a limit, we can't say we have unlimited sources. So always the higher unit contribution, like say have a 3 product A, B, C, and we have a limit on the labor hour to utilize one product giving £3 contribution, other giving 4, next giving 5. So 5 is giving higher contribution, so we will produce 5 more because we want to be maximize our return on investment. So the limiting resource to 5 because to maximize profit. Sometimes you selling those goods more and you prefer to sell more because those are giving you higher profits. Of course, we want in business to maximize our profit. Compound interest, S is equal to S is the sum of invested after period, certain period, the P is the present value 1 plus R is the return on investment, and which we can calculate. If we'll say you will get 10% and next number of years, so we can use the formula. So yes, so if we have 100 invested, 10% you will get, it means you get 121 after 1 year. So after 2 years, after 3 years, so you need to carry on doing, because the compound interest, will help. After 2 years, we'll get 121 pound instead of 110 end of the first year, and then you do 10% of 110, then carry on adding in the principal amount. That will be come 200 120 after compound interest, because on the interest, if you don't withdraw it, you will get top of interest. Okay, then the discounting formula, present value P equal to S. S is a sum which will get the total amount in your future 1 over 1 plus R number of n. So we can 1000 times by, and that will come, what we'll get total value. It's 5-year period of present factor in 0.75. If R is 6% and n is number of years, is 5 years, and then of course 1 plus 0.06 power of n, which is 5, and then that's your sum 1 divided by the scam, and then your times by, and we can calculate the present value. And if we know the two present value, the two, one positive and one negative, that will help. So internal rate of return, which show the rate of interest at the NPV is 0. IRR must be greater than the organization cost of capital for the project is acceptable. So if we'll say cost of capital is a 10%, so IRR should be more than 10%, because 10% is the break even where no profit, no loss, and we want IRR, internal rate of return, more than 10. So this is the formula we use, A discounted rate, A and B. During last lesson, I already discussed with you guys. Please make sure we calculate two NPVs. So one of the question in your assignment as well. So if I'll show you quick, open lesson 3, and then you do in assignment, you have a task. So with this, okay, like if you want to calculate the payback, you need to structure like this way the question, and if you want to calculate the NPV, you need to each project you write the years, you write the cash flows, you write the present value, which is a discount factor, then you times by, and then add the positive and minus negative. If positive is more, it's called NPV. The positive, we accept the project, otherwise we reject the project. So like this way we'll go through the other task statement, and for to calculate IR, we need one positive, one negative NP, and then we'll put in the formula and we can calculate, IIR. And we said IIR should be higher than the cost of capital. So project appraisal, IIR, time value of money, NPV. If it's a positive, we accept. If it's a negative, we reject it. Like here, pay for period and IIR. Here we look at NPV. We invested 100,000, we are getting after 1 year 20, 40, and 80, and then we have a discount factor, and then we multiply with it. Discount factor, which is always given in the question. So your inflow times by the discount factor, and we'll get and then difference between positive and negative cash flows. And NPV is the positive, and we'll accept the project, otherwise those should be reject the project. So task 1, we have a task 1 in the assignments, guys. The leaflet must be provide the information about the management accounting system, which compare the financial accounting system. So what you need to, guys, you can copy everyone these link into, and just go through and read it and do your assignment. So we discuss about break even, we discuss about costing systems. These are the management accounting. We discuss financial statement, book of prime entry, the financial accounting systems. Financial accounting systems start with the systematically recording the transaction in book of accounts. So you will see here, you can copy this and then you can go through, please. What is the financial accounting? What is the management accounting systems? And financial accounts, the management accounts can use, and how this help to make organization and the CNs in terms of the organization based on, and we use different systems. So if you have any question, feel free and ask me and go through these links, to address the task 1. Then task 2, we've been asked meeting to the board agenda and discussion about the financial statement. Financial statement come statement of profit and loss, statement of financial position, also known as the balance sheet, cash flow statement, and the shareholder statement. All these statements provide the financial information, and we record, and the stakeholders can make the financial decision based on these statements. And the ratios and the performance we can measure on by looking at these statements, and different stakeholders, they can make different decisions, like the tax office can make the decision either how much tax will you charge on these the profit and loss accounts, and various other stakeholders look around the liquidity position of the company. Then task 3, due to the reduction in the sale revenue and the fall in the group profit, the board of directors is investigating. So working capital, we can look around working capital. Capital is the capital which is capital, which is the capital which is in the company we have. Those are invested, all your asset minus current liability. That's called the running capital. So guys, to read it, running capital, and you want to calculate ratios, please just and already uploaded the formula as well. All the formulas on Moodle. In lesson 1 we discussed through, and if you have still any questions, so please ask me. Then if we'll go back to our assignment, what we need to and next task 4, and the task 4 we have, so you write column 1 is years, column 2 you write the cash flows, outflow, that is 750, then the year 1, year 2, year 3, that's your inflow, right? Then the next column is factor, we've been given the 4.5 discount factor, 5 and 6, all the discount factor given, so try to use one discount at least for check, and then we'll go through. So then discount factor times by the cash flow, you will get the PV. If the positive figures more than the negative figures, which is the outflow, and we accept the project, otherwise we'll reject the project. And please calculate to address this task. If you have any question, please ask me, or go through the lesson 3, which is the slide that will help you as well to address this. Then the last task 5, and the task 5 we have an input. We have 3 product A, B, and C. Those required and how much is we have. There are a lot of information we can look around. The standard cost minus actual cost is the difference, is the variance, and we can find how much is the finished goods cost by using this. Please, you can try to go this question if you have any question, and I already uploaded the variance formulas as well. So if you can't find it, so please ask me. I'll go through with you. Standard price we've been given and the actual price. So we've been given the cost. So that's the standard cost for 1 unit, and we are asking how many units. So final production for, and we need to look around what is the sale there. So cost, and then top up by 20% part we are selling, and then you look around the levels and you can calculate. If you can't, please ask me. I'll go through with you separately, each individuals. Anybody any questions? So today lesson we discuss about assignment brief, and I discuss with you remaining marginal cost, mean all the variable costs. Absorption costing is mean the full cost. Discuss you how we can divide the cost, costing methods, and the cost by element, cost by function, cost by behavior. And I discuss with you direct, indirect costs as well, and we discuss about short-term and long-term decision making, and I discuss with you investment appraisal. At the end, I copied the link to do the quiz. Please go through as well. If you have any question, ask me. At the end, it will show you result as well. Okay. Hope so all will see you next lesson. If you have any question, feel free. So we managed to finish this module. So please just work on your assignment and try to finish as soon as possible. If you have any question, feel free and me email on my email address. So also next unit when we'll deliver, and have a wonderful time. Thank you. Bye bye.